As always, it's my pleasure to have back with me today Charles Hugh Smith, well-followed and prolific writer on the web, who is the publisher of the well-recognized website of2minds.com. Time once again, Charles, to exchange some ideas, which I always look forward to. As I normally do, I need to clarify before we start, to stress with our new viewers that this is not an interview. We do these videos as a way of us productively dialoguing what we see to be important trends we're identifying, and simply make our synthesis discussion available to the public for those that might be interested or want to contribute comments, which we truly welcome, value, and read. That's what we look for out of these sessions. The subject today is whether the everything bubble is about to pop. As such, we need to consider whether the worries that I'm listing here are merited. Charles, is there any comments you'd like to make before we begin?
Just to mention that when we speak about the everything bubble, we're not being sensationalist. If you followed Gordon's work or my work at all in the last few years, you know that the extremes of overvaluation and leverage and so on in stocks and the housing market are real. And so this is an extraordinary moment in time.
To reach our conclusions, we'll first cover the subjects that I'm outlining here. I have quite a few charts that Charles and I have put together that we're going to go through, and I'll try and go through them quickly so that if you are interested, you can go back. There's so many that just need to be shown, so you just don't think that Charles and I are just speculating here. We've done a lot of research. You can always be flawed, of course, but the proof becomes a little overwhelming if you start going through the charts. We'll show you. There's been a lot of talk about economic growth and debt growth recently, as the U.S. is about to explode through $100 trillion level in total debt in the United States. And the relationship between these two measures, growth and debt, potential limits the growth to start the session. What are those limits to growth? If you look at total U.S. credit and debt, it has grown geometrically, as shown here, from $1 trillion in 1964 to breaking through $100 trillion, as I just said, in the last quarter two, just completed. Credit is equal to debt over time, definitely, but pretty close matches, and is the opposite side of the same coin. But if you look at just not the West, you look at the global debt shown here, we hit a new record in the first quarter of 2024, increasing by 1.3 trillion in just 3 months to 315 trillion. And since the pandemic, global debt has surged by 21%, adding 54 trillion global total. I mean, these are massive numbers, okay? And I'm sure most people are aware of them. But what do they mean? And if you look at total global government debt, it has exploded by 20 trillion since COVID. 20 trillion in new debt. We had 62 trillion in government debt on a global economy measured by GDP in 2020 when COVID hit, just under $85 trillion. But when we look at 2022, it will be $82 trillion with an expected GDP of $104 trillion. What we're saying here is it's $20 trillion of new debt to grow the global economy by the same $20 trillion. So what are we doing here? Are we growing debt or GDP? And it makes you wonder, in fact, and it should, whether we are actually growing the economy or just debt and how it is measured. And well, that is exactly what has shifted in our global economy, and you need to understand what you need to do to achieve how we measure economic growth is in the GDP formula. U.S. government debt since the advent of quantitative easing has actually been growing faster, as it shows here, than the economic growth as measured by GDP. This chart should be the most alarming chart in the media today, but I bet you not many people have seen the chart. And there are profound implications of this occurring that for some reason few discuss and the media completely ignores. Now, maybe they just don't want to frighten people, but it makes sure we realize what is actually going on. And as I pointed out in a recent Under the Lens video, in the U.S. now, another measure takes as much as $2.50 of new debt to produce $1 of U.S. growth. In the U.S., if you look at our deficit growth, growing our debt, the unbalanced deficit financing, it takes $1.50 of new fiscal debt to produce $1 of growth. And an adjusted crisis can be counted on to occur when debt growth is unable to produce economic growth or it is insufficient against the cost of debt. In fact, it is highly unlikely that debt growth required can itself even be achieved at these kinds of rates. And I'll get into that here in a second. Charles, any comments on any of those charts I just showed?
Yeah, I think, Gordon, it's essential that people understand that you cannot borrow your way to prosperity unless you're able to invest in productivity growth at a very high rate. In other words, in the ideal economy that we all remember at certain eras, then a dollar invested in a high productivity industry or a new technology, then that yielded, say, $2 or $3 worth of GDP, because the productivity of the economy was being boosted. But if you're just if you're borrowing money and pouring it into consumption or low yield investments or speculation, then you're not going to get the productivity growth. And that's really the big picture here, that what you're describing is we're borrowing huge amounts of money to get really modest growth. And that if we subtracted out the borrowed money, we would actually not have a positive GDP. Correct? I mean, and so this is where it's not good enough to just say we're going to borrow money to spend, to consume, and that's quote growth. That's actually not growth. I mean, the growth is from increasing productivity, not from just spending money. And so that's the picture that is we're describing, not just for the U.S., but for the entire world.
In a capitalist system, Charles, another way of saying it, you have savings that are invested in productive assets, and out of that you get a rising standard of living. In the system we have today, we don't have savings, we're creating credit. And that credit is being used, instead of investing in productive assets, is going into the consumption. And so we're spending it on consumption, which increases debt and never pays back. That, in fact, over the longer term, will reduce productivity and reduce the standard of living. And once you get into that trap, which we're in, it's very, very difficult to get out. And there are very few examples of recovering from it without a very major crisis. We've now reached the point that GDP growth, as we currently understand it to be, require debt growth at sufficient levels that maintaining an inflation level below 3%, that we hear about day after day, trying to get it down to 2%, and we're now at 3%, that it's going to be impossible to, based on the path we're now on, to actually sustain it at 3%. Something must change, and it will. The world is not coming to an end, and we'll show you how that's going to change in a moment. But the simple arithmetic says that they can't sustain it below 3% with these kinds of debt requirements, that has to be funded by available capital and collateral, that growth that's occurring around the world. It just doesn't work. And it's simple arithmetic. But before we get into a little more of this detail, we need to fully understand the importance of credit creation in today's global economy. And my longtime colleague, Richard Duncan, has long held the belief that capitalism, since the U.S. came off the gold standard, has changed to what he actually terms creditism. And he just released a 6-part video series entitled Creditism 101, with an extensive number of slides showing the evolution, which supports his book, The Money Revolution. And the chart from Richard, this chart here I'm showing now from Richard, captures the migration since 1968, when the U.S. first initiated the shift from settling its debt in gold to credit IOUs. And today, credit creation accounts for 61% of the funding of the U.S. government debt owed. And as a consequence, our world has shifted from capitalism, as I said here a second ago, where savings is redeployed as investment in productive assets, to creditism, where the credit is redeployed as spending on consumption. And the black bars have been more or less flat, as you can see here, since the late 1990s and dot-com bubble. And as savings, though, have been continued to fall, and has been made up of financing from the rest of the world, who I label it here as ROW, or at least Richard did, and the Federal Reserve increasing its balance sheet and the bank reserves. And the funding of the exploding U.S. government debt has really been created by two primary drivers. Domestically, by the growth of the Federal Reserve's balance sheet and bank reserves, thereby ensuring banks, financial institutions, and investors have liquidity to buy all those U.S. Treasury notes or debt. And internationally, by an ever-expanding U.S. trade deficit, which creates foreign FX currency reserves, or eurodollars are called, to invest in higher-yielding U.S. Treasury debt. And this is most quickly understood by reviewing the concept of the driven paradox. And Charles, you and I a few years ago wrote quite extensively on this as the exploding eurodollar was going. But both have led to credit growth that has allowed the U.S. to continuously consume. This is the problem. We're consuming far more than we actually produce and have been doing it for decades. Yet we're still realizing a rising living standard. It is, and the truth of it, it's been nothing short of a game of masterly modern alchemy that's been going on. With the further advent of quantitative easing, QE, Ben Bernanke's Enrich Thy Neighbor doctrine, and the stunning increase in the wealth effect, basically, we've created, knowingly or unwittingly, but as a disguised Ponzi scheme that has emerged. And like any Ponzi scheme, unless an ever-increasing number of new investors are continuously found, that the system will implode if there's any point at which the debt can't be financed or people want the money back that they've actually invested in the U.S. debt. Any comments on that, Charles?
Yeah, I think you've done an excellent job showing how credit has replaced savings as the source of investment. But one of the side effects of that, of course, is that then it becomes a matter of speculative gambling, if you will, where everybody can borrow money cheaply and then chase the chimera of higher returns by speculating in various instruments. And so people claim that, we're investing in this and that, but in actual fact, we're speculating in assets, whether it's real estate portfolios or stocks. And so that's part of what I think you're describing here is that the expansion of household net worth is not necessarily a reflection of the economy creating more productive jobs and investments. It's more like all this leverage pouring into various asset classes in kind of chasing a speculative return. And so that's the sort of the foundation of the everything bubble. It's not healthy actually to see household net worth shoot up by tens of trillions when the underlying productivity of the economy is flatlined.
I'm going to show a chart here in a moment on exactly the growth as a percentage on wealth, and it really brings it home. But going forward, obviously, savings is not going to propel growth further in a geometrically, U.S. growth, that is, in total credit and debt. It'll be lucky, and frankly, just really lucky, just to stay flat, rather than continuing the shrinkage as a percentage of debt growth. The Fed plus the rest of the world in this chart contribution is falling as China reduces its holdings of U.S. debt. De-dollarization continues to gain momentum in the application of FX reserves or currency reserves of money-sanctioned targeted countries who are reacting to U.S. policy, where they're using the dollar as a weapon. And recent selling by Japan, the largest holder of U.S. government debt to stop a falling yen, along with the yen carry trade unwinding, is adding further pressure to existing U.S. debt, never mind increasing their holdings significantly, which we need. We're lucky if we can hold it at this level, never mind the rate at which we have to increase it at. So, but there is a solution. We'll get to that. You may not like it, but that's what's probably going to happen. The U.S. investor is also under mounting pressure as the explosion in net worth, as I mentioned earlier, versus disposable personal income has reached this historical high of 776% versus a long-term average of 550%. All the contributors are simply facing significant headwinds to even maintaining the current levels, never mind significant and frankly massive levels needed to keep the geometric growth going. But it gets worse. If it can, but it does. And it may be actually the single ingredient that forces action sooner than later, because we can keep kicking a can down the road, sort of, and it'll happen at some point. But the driver is China. and the degree of its slowing economic growth. Charles, you and I have written about the situation in China many times now over the last few years, and it's been China that on 4 separate occasions shown here since 2008 financial crisis has actually come to the rescue of the global economy facing troubles. And the Chinese credit impulse has delivered the massive new credit and debt to further power a global economy facing ever-increasing imbalances between the credit and debtor nations. But that's not what's going on in China. China's in the midst of its worst economic crisis. The property market accounting for roughly a quarter of the economic activity in China is facing an oversupply of empty apartments on an inconceivably large scale, meaning that all activity in this industry should, but of course won't, cease. And the other pillar of China's economic strategy, export-led growth, is also under severe strain because the rest of the world is simply no longer willing to absorb China's glut of manufactured goods. China is not coming to an end. I don't imply that. But it's going through some structural changes that it has to accommodate the rate at which it's grown. And we did it. We went through some very tough times after the 20s and the 30s from the growth that we'd had. But it's not going to be there to be the economic engine that has been saving this imbalance and this geometric growth of credit and debt. Can China avoid a Great Depression? China's facing a demographic nightmare. Its population is shrinking and is widely expected to contract by at least 1/3 by the end of the century. And the government debt will have to skyrocket over the coming decades to prevent China's economy from collapsing into the Great Depression, just as Japanese government debt has since the Japanese economic bubble popped in the 1990s. The grave economic challenges confronting China were discussed in a video we just did over here at Mutasi.com, and under the lens called Can China Rescue the World Again? I clearly laid that out, and it's unfolding as we thought. Charles, I know you have some thoughts on China.
Yeah, thank you, Gordon. I would just add a few points here that China has saved the world, and not only, as you say, from the credit standpoint, but China's reduction of production costs, right, as the workshop of the world, essentially exported deflation for the last 20 years or 25 years, enabling nations like the United States to borrow huge amounts of money and sprint freely that would normally have triggered inflationary forces. And because China was reducing production costs, then that boosted U.S. corporate profits, and it also imported basically deflation into our economy. Now China's own cost structure is no longer dropping, and so they can't export deflation into the global economy, which is one reason why inflation is rising globally. So there's that. And then another point I'd make is that, China has a command economy. It's at some part of, as we all know, some parts of the Chinese economy are more or less free market, and then some are state controlled. And we all know that over the last, say, decade, China's central command of its economy has been increasing and reducing the amount of the economy that's more like open market. And so even in a command economy where the leadership controls all the levers of the economy, even China was unable to stop its property bubble from bursting. And that's what we're seeing. And we're seeing that property values, even in the tier 1 cities, are declining by 25 to 37% and more in the tier 2 and 3 cities. And so China's going to experience what Gordon and I have covered in the past and called the reverse wealth effect, because roughly 3/4 of all household wealth in China is in property. And so as that property loses value, that's going to have an immense a reverse wealth effect in China, where it's going to reduce people's sense of security and their financial expectations. And so they're going to probably be more willing to save money in savings accounts, save cash rather than speculate it. And so they may withdraw from consuming. And so China's likely in a recessionary state simply from the reverse wealth effect. And this occurs when every bubble pops. It's not unique to China. It happened in Japan, as Gordon said, in the 90s and 2000s. But it's going to happen in the U.S. too. We're going to have a reverse wealth effect as well. And so, in this sense, China is just another example of the dynamics that we're discussing here. You know, when you create or you allow a credit bubble to create an asset bubble, those two bubbles will pop, and it's going to generate a reverse wealth effect.
One more point to make, Charles, before we move to the kind of conclusions, what we think is going to happen and why, is that the world is facing additionally a looming, well, obviously a financial problem, but it's due to the lack of growth of unencumbered collateral. Credit is not extended and debt doesn't happen without collateral being posted to secure that debt. And now that's has become increasingly the limiting critical factor. And as we've written about many times, collateral is real wealth. You must either grow it, mine it, produce it, or build it. You can't print it. And so paper IOUs are only claims on real wealth. They themselves are not wealth. Honoring those claims in tumultuous times often depends on the solvency and continuing operation of intermediaries, third parties, and banks. You know, getting the claim fulfilled becomes a massive issue as times get tough. But they're not wealth themselves. They're just a claim on it. Today, a vast amount of paper wealth is highly dependent on the vagrancies of this highly leveraged quadrillion-dollar derivatives market. Claims which can suddenly be worth nothing. Markets are operating and trading on creative vehicles such as I show you, collateral swaps. Has anybody heard of those? Collateral transformations, liability derivatives. You know, the liabilities derivatives recently brought down the British Prime Minister. The gilt and almost sent the UK pension industry into collapse without anyone being even aware of what was going on in the global derivatives market. That's how exposed we are right now. And it has made everyone more aware of these concepts of rehypothecation and ovation of collateral that are going on, transparent to the public. And what are the consequences and conclusions from this? And these are just some of the key telltales to watch that I'm showing here. So what should we expect? What should we conclude? Charles, do you want to summarize the next two slides that you actually put together here on this?
Yeah, and let me start by saying, Gordon, that I think what you've described, and you've been describing it for 15 years, is the over leveraging of the economy via this hypothecation and all these derivatives, and this has created distortions which are invisible to the general public. They see the stock market and so on, and they see the interest rates on mortgages or cars. But the issue here is that the distortions are now so enormous that the system is breaking apart, and whatever is going to be done to keep it sort of duct taped together is only going to work partially. And so, because the distortions are now so enormous, and so moving on to this slide, like what do we need to keep watching? Well, the very high wealth to income ratio in the U.S. and the increase in interest rates to counter inflation, and the potential ending of the yen carry trade, and the impact of protectionism, meaning that nations around the world are deciding not to rely on importing essential goods and materials from other countries. They want to reshore or only buy these from friendly nations, et cetera, et cetera. So there's like a what we would kind of talk about here is the way that there's so many interlocking or interconnected dynamics, global growth, capital flows, foreign exchange, trade, protectionism, inflation. And so where is that going to take us when we kind of try to summarize those? And so our conclusion is, will the everything bubble pop? Well, history provides a definitive answer. Yes, all bubbles pop. Will the governments try to reflate the bubble? History's also definitive. Yes. Will the reflation work? In our judgment, no. And again, this is based on history. How can we respond to this situation, which Gordon and I have touched on or explained. And I think that the foundational observation here is there's going to be very little clarity going forward in the next few years because of the dynamics we've discussed and the government and central bank reactions to those. There's really no way to predict exactly what's going to happen. And so when there's very little clarity, then it makes sense to avoid wild speculation and that cash is king when there's little clarity going forward. And so what Gordon and I have talked about is self-reliance, like investing in ourselves, investing in assets that we own and control, physical assets, enterprises, or our own businesses. And we can, based on Gordon's roadmap, which he drew up, I believe, at least 15 years ago, which shows that the state and central bank response will be to increase controls and increase taxes, that it would be unlikely that there's going to be a safe haven that the governments are just going to leave alone. And so therefore diversification is a prudent strategy, right? And per the roadmap of higher financial repression and changes in the rules, we can expect to pay higher taxes. And so using the biblical reference of rendering unto Caesar the things that are Caesar's, we can just expect that, and that's going to be the way it is. And so if we're going to be paying higher taxes and for possibly higher prices due to inflation, we have to our best interests are served by trying to reduce our expenses. And one way to reduce our tax burden is to reduce our net income. And that's generally not considered advice, right? We're all supposed to make more money, but sometimes it benefits us to make less money and live within our means as a strategy of reducing our taxes and our exposure to risk.
Charles, I've been in this game here for literally decades now, and I've seen a lot of major crises, market crashes. One of the things that is consistent is that when they happen, the government actually never fixes the problem. It just doesn't. It may modify something or but what it does is it changes the rules. It changes the rules. The most clear example how we got out of the 2008 financial crisis was we allowed the banks to mark to magic from mark to market all their $80+ trillion of derivative structures, and they never changed that. They're still in. So we can go through every crisis of the games that was played that effectively have made the system more and more fragile, more and more exposed as we went along, because there was good reasons why we had certain underpinnings going on. So we can expect that again. That's what will happen as we begin to face this inevitable, obvious crisis that's looming. And they will be proactive in it. So what are they going to do? It is my measured assessment. I could be wrong, but it seems to me it is the obvious play. They're going to move, if they already aren't doing this, to the use of what is referred to as off-balance sheet. This is not something that's reported on a balance sheet, and it's accounting called contingent liability guarantees. And the U.S. has long been using this process for foreign aid. And that is, the U.S. doesn't necessarily give foreign aid directly, but rather guarantees the loans banks make to countries receiving the aid. And that aid comes with terms that if defaulted on, the loans become due, and the U.S. is on the hook for payments if the defaulting country can't or won't make the settlement. That's only then that it comes on our books. And in 2015, a local professor here, Lawrence Kudlikoff at University of Boston, presented to the Senate Banking Committee on Finance what he called the fiscal gap, which includes U.S. government contingent liabilities and net present values of extended long-term debt obligations such as Social Security, and it was $210 trillion. Let me say that again, $210 trillion of exposures. And his report is still, at least today, currently available online. I don't know for how much longer, as those numbers will continue to change. Pretty soon governments will be, in my opinion, in the guarantee game to ensure that every increase in credit and debt streams generated to keep this Ponzi scheme from imploding, and you will not see them. you will not know what those guarantees are or what those terms and conditions that will come out of the United States Treasury. And that makes our system weaker, but it will extend it. And that may be totally transparent to you, and we have another big growth spurge, and more debt is created and more credit. The world is not coming to an end. But understand, more and more risk that starts to come with that. But in response to future crises and disruptions, we should expect the state to resort to other things, drastic measures, in parallel with that, as imposing price and capital controls, nationalizing banks and large corporations, and transforming the economy into a more highly regulated, centrally controlled command economy. This is a natural evolution by the nature of all of the steps we've been taking. I'm not saying it's planned, it may be, but it is the predictable outcome that we're on. It's a path that if you understand, it's much easier as an investor to make better measured decisions. I just noticed Vice President Kamala Harris, now running for president, just announced that she's bringing in price controls as a pillar of our economic plan to counteract rising food prices. And I said, this is what we should expect, and there it is. These developments may be sooner, actually, than Charles, you and I think that they're going to be happening in real time. And there is little doubt in my mind that regulatory repression, and I've written extensively about this, it will soon be in addition to the long practice macroprudential monetary policy of financial repression. We're going to use regulatories in a much, I don't like the word harsher, much more demanding and controlled fashion to keep the wheels on this growth, or we're going to have something that none of us want. And they're being forced to do that. And I expect Charles and I will continue to outline all of these developments regarding advanced regulatory repression in our writing. Charles, any comments on any of that or anything you'd like to make? I guess because we're going to have to wrap up here or up against our hard line.
Yeah, Gordon, I want to kind of just end here on reemphasizing that we're presented generally in the media as having an organic economy. In other words, that it's self-regulating, that people are borrowing and spending money and doing all these things, and that it's an organic system. But in actual fact, that's not really the case, because we've substituted credit for an organic economy. And so once you rely on credit as a replacement for a real economy, if you will, then you've created an incredibly distorted, over-leveraged bubble. And that's what we have globally. And so knowing that, then we can anticipate that authorities globally, and there'll be different changes depending on which nation or whatever, but in general, every government and every central bank is going to be throwing stuff at the wall and seeing what sticks. And this is actually what happened in the 1930s, in the Great Depression, is governments and central banks just threw everything they could think of at the wall to try to keep everything sort of glued together. And so there's not going to be a master plan, as you say. There's going to be a lot of contingencies and stuff that's going to fail. And some stuff will work temporarily and so on and so forth. But to your last point that you mentioned, what we're seeing is not that the global economy is going to be destroyed and we're going to be living in the field in cardboard shacks. It's what we're saying is there's going to be a massive rebalancing of all this excess credit and leverage, and that's going to have to go away one way or the other. And then the stage will be set, if you will, for a return to an economy where we can invest in actually productive things that improve our productivity as an economy and a society. And until we get there, then we have no clarity. And so it's best to play it safe.
That's why what we're going through, many refer to as generational cycles, Charles. A lot of things we learned in the 20s and the 30s been forgotten, and there's an adjustment, and the new generations will take us back and start to revisit a lot of things that happened in the past as if they're new ideas. Keep going through it, and this is part of this fourth turning that we're currently in, and you and I have been talking about it and the other cycles coming at this period here between 2022 and 2025 for well over a decade, and it's here. this massive change that's is happening, about to happen, and accelerating right now. And we'll be fine on the other side of it. And the world will be stronger, more productive, more integrated. You can almost be assured of it. But it doesn't mean between now and then, and maybe it's another 10 or 15 years, there's not going to be very, very difficult times. But, biggest fortunes are always made during the most difficult times by those who really see what's happening and take advantage of it. So there's actually, in my opinion, there's never been a better time for investing than there is right now. But it's not for the faint of heart, and it's not for those who don't do their homework. And I mean seriously do their homework, because nothing is as it seems to appear in this current world of what we're doing in the financial arena. That's my humble assessment and personal opinion. Charles, we have to wrap. I thank you very much. And we'll meet and talk again in another month or so. Talk to you then.
Okay. Thank you, Gordon.
Thank you very much.